Every trader always has this question: what is the best strategy? Maybe in your early years and now that you are educating people, how did you come to say, now this is my strategy?
Well,
Hi guys, good afternoon. Yet another evening from Nairobi. I'm your host Jesse, of course, joined by...
Hi guys, Rufas Kamau here, looking to do another episode of the Bullish Banter podcast.
Yeah. Since the last episode, I think we went sort of brief but deep in regards to central bank divergence and in terms of their policy. And as we record this on the 20th of June, 2 hours ago, I think we had the Bank of England maintaining the course. Maybe what is your opinion on that?
Well, it was weird and unexpected. And this is based on the policy we have been following, the forward guidance from the Bank of England.
Yeah.
So since 2021, when they started hiking interest rates, they have been pushing the same narrative that as soon as inflation gets to the 2% target, then we are going to start considering cutting interest rates.
Yeah.
So as of the data that came on Tuesday this week, overall inflation dropped to 2%. So I was expecting to see at least a cut or a shift in the voting pattern, but seeing 7 members holding rates and only 2 going for rate cuts, I think it was a surprise for me.
Yeah.
Though, of course, analysts in Wall Street expected the Bank of England to hold.
I think it's interesting. We are in the topic of divergence. So I guess they are diverging and staying their own course, which is interesting because I think yesterday Rishi Sunak was also being, sort of removed from being the party leader of the Conservatives, and that really, I believe, could have had some impact per se on future government policy and of course the pound itself. Are we likely to see Bank of England follow the US? When the US acts or the Fed acts, we expect BOE to act. Is it something that for them they'll be doing their own thing together, because at the end of the day, UK is not in EU anymore?
Well, from what I'm seeing from the political scene in both countries, that is the UK and US, there's a likelihood we'll be having an election in the UK earlier than the US. The US is November.
Interesting.
So in this case, I expect Rishi Sunak to basically harvest the low-hanging fruit. Having achieved 2% inflation is a win for him. So he'll try to push that narrative to go for rate cuts closer to the election.
It's an interesting year, I cannot lie. There are a lot of election happening everywhere, even the elections which you didn't know. Rather, not that you didn't know, you didn't really pay attention. Like, for example, myself, I didn't pay attention to, EU parliamentary election.
Yeah.
And for some reason, they had an impact on the euro bond markets. It had an impact on the euro currency, basically the European currency. Yeah. It should be an interesting year as we go into the major ones. I think we are done with India, South Africa, which would really, impact several aspects of the economy.
Yeah.
Now I think UK and US will be focused for the next at least 2 or 3 months, especially after the videos we have seen of Biden.
Yeah.
That should be quite a spanner in the fireworks, I guess.
Yeah, it's crazy, especially when you look at Americans. There's, of course, supporters who go for Biden.
Yeah.
And now they're looking at him and wondering what's happening with him. Are they making the right decision going with him compared to another candidate?
Yeah.
So there's a good chance we could be seeing some volatility leading to the November elections in the US.
Yeah, true. Yeah, so I'm saying like this year is quite interesting given the number of fundamentals sort of driving the market. So definitely some degree of volatility we should expect in the coming days. And this is important as we go into today's topic, with extreme volatility driven by a range of factors, be it geopolitics or conflicts, be it trade policies, be it central bank divergence in policies, be it, usurping or, change in majority within the several legislative agencies. From your experience, I guess, what would you say to a new beginner? Like, you have all this. Is it bad to trade?
Yeah.
Or is it good to trade during these times? And more importantly, how do you factor in all these things in your individual trading capacity?
Well, as I always say, the volatility is vitality. The only way you can make money in the markets is when prices are moving. So when there's no volatility, there's no chances of making money. For instance, if you look at yesterday, the 19th of June, the Americans were celebrating a holiday called Juneteenth. So during this holiday, the markets were literally quiet. So we didn't have much of a move. If you looked at the currencies, nothing was moving around. So even if you executed major trades, you wouldn't make money in such a market environment. But when there's these central bank divergences, look at European Central Bank, it's cutting interest rates. The Swiss National Bank went for a second rate cut this year. And comparing this with, let's say, the Federal Reserve, which has held rates higher, that creates a divergence between the two central banks. So if you look at a currency pair like USD and USD against the Swiss franc, they're all making major moves, which creates an opportunity for you to make money. So don't be afraid of volatility. In fact, what you should be concerned about is risk management. So when prices are moving a lot, the risk increases in the market. So while the opportunity is also the same, you have to be prepared to protect your money, make sure that you are only going for the best trades. And in case you're wrong in the markets, you exit with a small loss.
Yeah, I think what is quite evident, and I'm sure you have seen this over the last couple of years, we have seen there will always be something coming and you do not expect it, but it shouldn't scare you, I guess. Every decision you make in your investment decision should be like when you're navigating a roundabout or exiting or entering the major highway, you always need to look who is besides you, what is coming behind, and perhaps something that can indicate what might happen in the future.
And there's always a Buddha guy.
Yes, because you might think, there is no one on my right. Somebody is coming way back. They are 200 kilometers an hour. So that can be very dangerous. In regards to the markets, no one, I think personally, I didn't really pay attention to the EU parliamentary election. I don't think that is on my side, let's say one of the major fundamentals events I look at, but they had an impact. And therefore, next time I'd be wiser to pay attention and factor that risky aspect that you have said. Because at the end of the day, risk and opportunity go hand in hand. The higher the risk, the higher the opportunity. Now, how can you individually make a strategy to accommodate this? And I also believe that strategies, they can be similar. I guess it starts with how much am I willing to risk? And then from there, you're able to decide, because I tend to believe the gains are exponential, but the risk can be, set term. I don't know if that is something you agree with.
The risks can be mitigated, but gains are exponential,
Every trader always has this question. What is the best strategy? I don't know, maybe in your early years and now that you are educating people, how did you come to say, now this is my strategy?
Well, I think I went through a lot of strategies in my trading career. My very first strategy was the simplest, which is basically trading the moving average crossovers. So the guy who trained me was like, follow this moving average. So he would have 100, 50, and then 12. So you consider the three moving averages. So when the fastest one, which is the 12 moving average, crosses the 50, then you have a signal, execute your trade, and once it gets to support resistance, then you take your profit, wait for the next crossover.
How long did it work for you until you now move on to your next strategy, and what necessitated the move?
So it worked for like 3 months. So with my first account, I think I was up, like 300%. I would call it maybe beginner's luck. But I was just following the same exact strategy. Every time there's a crossover, I execute a trade, no crossover, I'm out. And I was majorly trading just the major currencies. So I traded for a while, made some good cash, and then I got overconfident. So by the time I was stopping, by the time I stopped using the strategy, what I was experiencing is overconfidence in the market with this strategy. So instead of going for the usual lot size, I'm risking 1 to 3%, started going for much bigger lot size. So I ended up blowing my account, and to be honest, I blamed the strategy.
Now, I think I'll just double down on that a bit. Strategy is something very hard. Personally, I think I approach different markets differently, and that is for my own sanity. For example, if I am going to stocks, I'll not be thinking of the way I trade, even if it is derivatives stocks. I'll not be thinking the way I'll trade gold or oil. I will not be thinking the way and applying the same strategy on currency pairs, for example, and the same applies to indices. Just different approaches. I think for me, it's mostly risk management. So I look at what is the margin requirement, what is the PIP value, and then am I okay with the lot size I'm putting? That is done. On your side, when you said you became greedy, is that a bad thing?
Well, I don't consider greed as a bad thing, but there's a limit.
Okay.
So when you're excessively greedy, then you start making mistakes.
Interesting. Because last time we had a band, I asked him, have you ever blown an account? And he told me no. And I was like, why would you say that? Because blowing an account, I don't think it's new to any trader. It's not new, but rather foreign. You must experience it at some point. But he told me something which I think I agree with, that by the time you blow up your account, you didn't have a risk management in place from the start, because you went full margin in your account, chasing triple X or 10X returns, and no strategy at all, pure gambling. Well, do you agree with that, or at least based on your experience now and reflecting back to what we are doing today?
Well, I think there's a huge difference between band and the average Kenyan trader.
Okay.
So for me, when I started trading, I didn't have a secondary source of income.
Okay.
So you deposit $200 in an account. You're not looking to make 10%. You get where I'm coming from.
Yeah, I get it.
And I think I've seen this with a lot of Kenyan traders.
Yeah.
So when you deposit that $200, especially if you land Forex from, let's say, out of either influencers or people who are making it big in Forex, you don't think in terms of risk management or acquiring the skill fast and then growing over the next 5-10 years.
Yes.
Most probably you're looking to make money. You're looking to get some money to buy something and pay a bill over the next week or month.
Yeah, just say go and buy iPhone 15. Don't It's a necessity. I mean, you need to take good, but unfortunately, that is a situation which...
so it's not like you don't know about risk management. You know, like deep down, you know, I'm supposed to go for 1%, 2 or 3% risk, and then target to make 5%, 6%.
Okay.
But then you do it for the first time, it works. You do it the second time, that time, and a few weeks later, you are so confident in your skill that you know I can literally flip this account.
Okay.
And I've done that like so many times. But the moment you get into that mental framework where every time you deposit some money, you want to flip it and get double that, then I think it becomes quite dangerous for you, because you're not thinking about the risk you are taking by constantly and consistently looking for opportunities in the market. And over time, you realize that you take that one bad trade that literally breaks your account here.
Would you say, rather, did you name your strategy first of all? Like you give it your own Rufas?
No, I didn't name it.
Concept.
It wasn't even my strategy.
Okay.
I was taught, like, these are moving averages. This is how they work. You do this. And the guy who taught me, like, he was like, I've been doing this for a while. And if you do it exactly this way, then you're going to get my results.
Okay.
But I wasn't satisfied with a small return, like 10, 20% return a month.
I'll blend a couple of topics, but I think it makes sense not to regurgitate the same thing. After 3 months, and I think I have almost similar experience, but I think mine is basically, I don't know, I like to use candlesticks or price action. I think it's simpler for me, and the fundamentals a lot. I do pay attention to fundamentals. But I tend to have, let's say, 1, 2, 3 months of some realistic, sustainable results. And then just one trade whereby I lean so much on the fundamentals because the technicals are already doing their thing. Or rather, I lean on the other side, technicals, and ignore the fundamentals, meaning the change in sentiments in the markets, the change generally in either bullish or bearish, momentum in the markets. I say, it will come back. It will come back. After 3 good months. And if you look at it, it basically disregards all the rules you always have in your checklist. Would you say that it is not the strategy that you need to change, but rather adapting your strategy to the mood in the markets,
Yeah.
to the sentiments in the market,
Yeah.
and more importantly, to the general political or social environment.
Well, I don't think strategies should change that much.
Rather, adapt.
No, I don't think the strategies should adapt.
Okay.
Think about it this way: your strategy is a tool.
Okay.
It's like the pen you're holding right now.
Yeah.
Use it to write, right? So the strategy you use to approach the markets should be a constant thing. You may do let's say after 3 months you reevaluated the strategy, find the weaknesses, try to improve on the strategy. Let's say how you filter trades or the levels you set on an indicator if you use one.
Yeah.
But the strategy should always be the same. Remember, there's, I would say, 3 simple goals. So the moment you deposit money in your account,
Yeah.
your number one goal is not to lose that money, right?
Definitely.
The second one is about the trades that you execute. So you don't want to be consistently in the market. Every time you're in the market, you're taking risk. So you only want to be in the market when there's a really good opportunity. So your strategy should define the roles that present a trading opportunity.
Okay.
So you might look at charts. Let's say you wake up one day, you look at Euro USD, you look at gold, you look at the Nasdaq 100 index, you look at oil. The moment there's an opportunity, it's not you who visualizes the opportunity, it's the roles in your strategy that tell you that this is now an opportunity to enter this market.
Okay.
So one side, risk management. Second one, identifying good trades.
Yeah.
And of course, the third one is, of course, trade management. So once you find a good opportunity and you execute, you still need to manage that trade. And this need basically implies the rules for adjusting your stop loss as well as your take profit. And of course, what determines your exit from that market. So the moment you get those 3 covered and you're disciplined enough to follow that strategy, then the rest is about surviving different market cycles. Where yes, there are periods when the market will not be very favorable to your strategy, but your strategy has good risk management, so your account will survive. And when the market conditions are good, then you'll make some good profits.
I think what I'm getting from that is, you're sort of bringing me to your side of not changing, but rather pay attention to where the winds are blowing.
Yes.
If, for example, something major happens today, why I'm saying adapting is because we don't know what will happen next year, right?
Yeah.
And we know where we have come from in regards to COVID and all the post-COVID uncertainty and the geopolitics that followed.
Yeah.
That really made it maybe within a month or so very hard to predict.
Yeah.
But the markets are moving to a certain direction. It's only that you are not really like today, or I know we have covered this so many times for those who have been paying attention.
Yeah.
NASDAQ and the Dow Jones,
Yeah.
generally equity indices, they might and they have a history of always closing on a high on an election year.
Yeah.
And generally they do 10%, 20% annualized or let's say appreciation year on year, right?
Yeah.
So you already have that historical data. Of course, not a guarantee of the future, but it is what it is.
Yeah.
But you find where it is now at 20,000 at least as of today.
Yeah.
That is the second time this year it has touched it.
Yeah.
And possibly it might do that and even exceed it within the next couple of months.
Yeah.
So you are stuck in that indecision circle of you have your strategy. Maybe you use SMC, you use ICT, you use your moving averages, you use RSI, you use price action, demand and supply, which is basically all of it combined. Or fundamentals or technicals only. But at the end of the day, so long as you have, the understanding of the momentum, the strategy will at least find a way to, be fluid with whatever happens. I don't know if it does make sense. That all these disruptions will happen within a month, and then after that, the market has already factored in, priced them in, and therefore they become irrelevant noises to be always, going back to, this year, okay. Like right now, we know the companies driving NASDAQ, and they likely do continue to do that. It is not like they'll do something opposite because companies tend to think 2-3 years ahead. I guess that's my point on that. Now that I've mentioned ICT, SMC, whatever, personally, I don't think they are bad. I don't think they are not profitable.
Come on, we both know it's marketing gimmicks. Like,
Yes, wait a
let's
minute.
talk about ICT.
Wait, I'm saying this simply put, yeah?
Yeah.
Strategies are personal. They are not, curriculum for the mass. They
Yeah.
are personal.
Yeah.
So if it doesn't work for you, it doesn't mean it is bad.
Yeah.
It means some aspect of that strategy is
But
bad for you
Yeah.
personally, right?
yeah. Yeah.
I don't know if we're together there.
Yeah.
Now, of course, if you go and claim that one thing is 100% foolproof successful,
Yeah.
then now that becomes a gimmick.
Yeah.
Yeah. So for me, I don't mind anybody using whatever they use. At the end of the day, if you're making money, who am I to stop you?
Yeah.
That is, I think, what I mean. But it goes down to the three things you said: identify opportunity, trade management,
Yeah.
and I guess
Risk management.
Risk management.
Yeah.
The three simple steps.
Yeah.
So however much you pick from it,
Yeah.
always you yourself individualize it.
Well, the thing is, I would start with what? If you really study the markets
Yeah.
before you start trading,
Uh-huh.
there's some basics that you must understand.
Yeah.
For instance, it's candlesticks. You have to understand how they are formed and what they tell you in terms of what's happening with price action,
Yeah.
right?
Yeah.
It doesn't matter what you call a support or resistance area, it's still the same thing. So whether you call it as SVG or whatever, the thing is,
Fair
it's a,
value gap, etc.
yeah, it's a support area. I have seen people calling it the daily low, another one a weekly high, weekly low. It's still the same thing.
It is individualized naming of the same basics of it all: support and
Yes.
resistance.
Yes.
Okay.
So you're basically tracking a point where, let's say, market participants changed their decision about an asset.
Yeah.
So, for instance, how did we see drop recently? Tesla.
Tesla. Yeah.
Yeah, had a massive drop of about 26%, got to a really nice support area. So it doesn't matter how much you call it. Any price action trader can observe the price, see the price was going down, and now there's evidence that buyers are coming in, then they go for the same trade.
Okay.
So you'll find that if somebody is trading smart money concepts, another one is going for ICT, another one is just a price action trader, another one has a system of technical indicators with a lot of lines on their charts, but they're all saying the same thing, then it doesn't matter. I don't see why there's a conflict there. So the thing I'm saying is that I don't see why there should be conflict, that my tool works better than yours doesn't work. It's more like if I have a tool and it's working, and you have a tool and it's working, then let's have a conversation about how good your tool is working versus how good mine is working, to see if there is benefits to be had from the conversation. So if I see a trader who is saying, I do SMC, market maker model, I'm doing ICT, I'm doing price action, I don't immediately feel any, any reaction to that.
Okay.
So the next part would be, what's your drawdown? Like, how much risk are you taking per trade? What's your risk-reward ratio? How much typical return are you getting on average each month or each week?
Yeah.
So I would try to go deeper to understand the dynamics of your trading.
Okay.
And then if it's working for you, I might even borrow some concepts from you.
Definitely.
Yeah.
I think that's the point, because I in financial markets and speculative markets, to say it,
Yeah.
there is usually outliers, and they form 1 or 2%.
Yeah.
Nobody can be George Soros. Nobody can be, I think, is it Zenga?
Yeah.
Nobody can call shots like the late mathematician. I'm forgetting the name.
Yeah.
Yeah, the one who passed on, unfortunately, it was, let's say, 100% beat of S&P 500 for the last almost 40 years. There is usually just one outlier in a decade, in a generation or something.
Yes.
But in your individual capacity, your ability to sustain yourself and maintain your ability to be a player is much better way to build a strategy around for the longevity than taking that one holy grail or hoping to find one holy grail that will work out for you.
Well, the thing is, in the markets, the only holy grail is you. Seriously.
Okay.
There's no way you can corner the markets.
Yeah.
In fact, for a market that obeys no rules, So even if you have rules in your trading, the markets will not always obey those rules. So what I'm trying to say is that there is a single day that you'll do all the fundamental research you can, be as objective as you can, plot your trend lines, indicators, do your analysis, and identify one premium opportunity, one that you've been using as a whip. Every time the market does that, you whip, you get some good pips. But then this time, you do it so well, and then you execute your risk as usual. Maybe you risk 1%, and then immediately you execute that trade. It heads straight for your stop loss.
Do you know if you're right? If you are right, do you normally, let's say it has been working out for you 9 out of 10 every time, and this 11th trade you executed failed because of market open, volatility spike, some news came out before 1 hour before market open, or just some announcement from the government. Do you normally go back and execute because now it has come back to your opportune moment, or you lay off until now things are calm?
Well, I've learned to go outside and touch grass.
I think I'm leaning towards that side.
Well, not literally, but I would try to not to go back to that market.
Okay.
No matter what happens.
I think it's a lesson.
Because I've done that mistake before. You make a trade, market head straight for your stop loss, kicks you out, but then starts showing some signs of moving up again. You go for another buy, then guess what? Head straight for your stop loss again. And then if you keep repeating the same cycle, you might even blow your account in a day. So the idea is if you've analyzed a trade, a setup, and a setup can take several days before it's mature. Then when that opportunity comes and you execute that trade, if it goes for your stop loss, just accept that this is the nature of the market. We cannot predict the future. We are only trading based on probabilities. So in that case, you let go, take a breather, and then track another opportunity, and then do the same thing. So if you have a good strategy, it's more about trusting that this strategy will deliver me good returns after some good number of trades without focusing on the outcome of one individual trade.
Excellent. To the most interesting bit of Kenyan situation, or generally sub-Saharan, and let me put it like that. Most young guys are actively involved in what else can I make money, and one of the easiest ways is online forex trading. And this guy, they are okay losing $100 like you put it, or $200 like you put it, or $500 if they are in a place where disposable income is quite higher, and they will execute full margin trades. So scalping basically. Personally, I find scalping stressful.
Of course it is.
But exciting. Sometimes when you have a few dollars and you want to play around with your
there's also
your blood pressure.
There's also that adrenaline kick that you get from trading. But I think there's one thing that really messes you up, especially when you are going full margin. So you realize that guys who go full margin, they will time high impact news when there's a lot of volatility in the market. And they start one really good time when you are very lucky. So you have a $500 account, you time a big announcement like NFP or CPI announcement, you go full margin, big lot size, you keep adding those trades, and at the end of the day, you are up $500 more or even $1,000. And immediately after you do that, you know that this thing can really work.
Okay.
And then you'll be in that psychological or mental trap where you want to experience the same kick of adrenaline you had last time, where you made $1,000 from a $500 account in one day, or even in 1 hour.
Okay.
So you'll subconsciously be looking for that feeling, and even if it's not existent, and it can lead to a cycle where you keep blowing accounts trying to achieve the same thing.
Would you consider day trading scalping?
Well, day trading is not scalping. In fact, the way I think about day trading is, I would call it a dead culture.
Okay.
So it's a culture that used to exist back in the day when trading floors were there, where traders would go to a trading floor, they would execute trades within a day, and they would have to close them before the market closes, so they don't pay interest for holding trades overnight so that they can, let's say, continue those trades the following day.
Okay.
So people would target, let's say, positions in the morning or between the day, and every time they make a profit, they close the trade. For the ones which have still not yet realized some good profit, then they would close them at the end of the day. They would rebalance their month, and then those trades would be settled T plus 2.
Okay.
That is 2 days after the closure of those trades. But then today, the digitization of financial markets and trading doesn't make sense for you to say you are a day trader. Let's say you like your sleep. Maybe that makes sense. Where in this case, you want to open your trades within a day.
Yeah.
And then by the time you are, let's say, trading session or trading day ends, you want to close your trades, have some peace, go have a beer, go have some nice cup of tea. Maybe that's your, cup of tea. That's how you approach the markets.
Yeah.
And you don't like having open trades. Maybe you have anxiety issues. That could really work for you. But for someone without anxiety issues, someone who is very disciplined, it doesn't make sense to say you are a day trader when if you capture a really good trade, you can ride it for a couple of days. For instance, look at oil.
Yeah.
The oil this week has just been bullish.
Yeah.
Right from the opening time on Monday morning, has just been going up and up and up. Today is Thursday. And why would you do the day trading if you capture a really good swing trade and keep holding it? All you have to do is to keep adjusting your stops. So it doesn't make a lot of sense to say you're a day trader unless you really like your sleep.
I'm noticing something very interesting in Kenya of late, or at least among most traders in the social space that I'm looking at.
Yeah.
People are getting very, involved in fundamental analysis. And this is in line with scalping as well.
Yeah.
And I think that's a good thing because it means financial literacy is deepening.
Yeah.
People are getting curious that I cannot just be making these dollars without understanding the original source of the price action.
Yeah.
And maybe from your side, what would somebody who is just beginning to understand what is FOMC?
Yeah.
What is the significance of that statement at 9 p.m.
Yeah.
and 30 minutes later the speech, the interview to the markets, and for them to apply it in their trading decision? What would you guide them to look at, and maybe how do they, classify which fundamental is significant and which one is just maybe
Think about it this way. Let's say you're a fisherman.
Yeah.
Somewhere in a lake or ocean.
Yes, like Lake Victoria, yes.
Yeah. So for you, you're looking for, let's say, a specific kind of fish.
Yeah.
So you track their patterns and how they move. And today they might be here, tomorrow they might be in that area. And you're always going for that area where there's more fish to get some good product, right?
Yeah.
But then there's some different types of fishermen who basically consider what's currently happening with the tides. So they'll study the patterns in the tides.
Yeah.
And if the tide is moving this way, they'll direct all their fishing in that direction.
Yeah.
For you don't consider the tide. So sometimes you find yourself going with the tide. Sometimes you're going against the tide. So you find that you're doing a bigger job when you're going against the tide, and you don't really understand why. And that may explain what's happening with the Kenyan traders right now. So they are realizing that the people who actually do consider fundamental analysis in their trading, they understand the overall direction of the markets. It's not like they execute better trades. No, they basically understand that overall, this market is moving in this direction. So you'll find that those traders will avoid trading against the tide. So for instance, last time we talked about central bank divergences.
Yeah.
So we know that there's a huge divergence, for instance, right now between the dollar and the Swiss franc, because the Swiss National Bank has been cutting rates twice in the last 2 meetings.
Yes.
And the Federal Reserve Bank has been holding rates steady. So looking at the two central banks, the big divergence in their policy leads to the dollar gaining against the Swiss franc, right?
Yeah.
So for a trader who considers their fundamental analysis, they know that this is the overall direction, but the timing of their entries, exits, their risk management will determine their outcome, right?
Yeah.
But then for a trader who is not following the fundamental analysis and they are doing technicals, sometimes they may even see signals to short the pair, even if long term is going up. And of course, if you're fighting the trend, most of the time you'll probably find yourself losing some trades unless you are really good at what you're doing.
Yes, the point is that you cannot really consider yourself a fundamental trader or a technical trader.
Yeah.
Because whatever strategy you use, all of them must at some point be factored in. Because you usually say this is a train and the fire will always be the fundamentals. After it is done, the market players will take their role. It's like a shooter, on a sprint, 100-meter sprint. When the gun goes off, the horses or whoever is the athlete goes off the barn or the trucks, and you go different directions. So that's how I view news.
The thing is it doesn't really matter, like whether you're a fundamental trader, whether you are a technical price action, ICT. I don't care. What matters is what you take home.
Yes.
Either of two things. One, you're not blowing your account. You're not losing money. Two, you're making something from your account. So once you get those two things fixed, even if you identify as a moon trader, it doesn't make sense. It doesn't really matter. Okay. So the thing is, for a person who is more informed, they are better prepared to tackle the markets compared to a person who is less informed. So a person who is doing an extra work of studying what's happening with the fundamental analysis, they have a better chance of responding to how the market moves.
Interesting. How do you factor in, backtesting? And what would you consider backtesting in a way that you're able to foolproof a strategy? Or not foolproof, but, get the accuracy to the, agreeable number. How do you go about that?
Well, backtesting is all about building confidence. So, for instance, let's say you are a novice, you have never traded before, and then you are like, Rufas is a good trader, I've seen his results, let me learn from him. I come and I train you and I tell you these are 3 moving averages. It's 100, 50, and 12. So if the 12 crosses the 50 going up, go for a buy trade. If it crosses the 50 going down, go for a sell trade. So in that case, I haven't given you any form of back test, right? So you go and execute that way, and for some time you make some money. Some other time maybe you grow overconfident and you lose some money. So what happens next? You start looking for the next best strategy that you think will give you better returns than the previous one, right? So the whole essence of doing a backtest for your strategy is to build conviction and confidence. So traders will build conviction and confidence by backtesting over a longer period of time. So you're basically asking yourself this question. If I use this strategy, trading Euro USD on the 1 hour chart over the last 2 years, how much would I have made? How much drawdown would I have taken? So would my account have survived all the ups and downs that happened with Euro USD? So if you see the results are good, then you trust, you have the confidence to keep using that strategy over the next 2, 3, 4, 5 years, knowing that this strategy is good, it has survived different market environments.
I think it's fair to mention that you can do this on MT4 and 5 if you know how to backtest it. If you cannot or you do not view paying for trading view all the subscription fees visible by you, Googling on YouTube can be able to give you at least on PC. Going back in time, applying maybe your moving average or whatever indicators you use, and it gives you the result depending on the time frame.
But apparently, from a psychological aspect of view, people tend to put more focus on something they have paid for than free one. Like seriously.
True.
I don't know how to describe it. At FX Pesa, we have an office in Kitengela, right? So if you go take a trader there and tell them you have free classes that learn every day from Monday to Friday, come here and you learn how to trade. This guy will even miss some classes on a couple of days. But if they go to a private session where they pay, let's say, $1,000, they will put more focus and effort to make sure that they learn everything to squeeze every value out of that $1,000.
As we tangent off the discussion, it's very interesting that you say that, but it is surprising, very, very interesting that people like discounts as well.
People like discounts.
Or free. So there is
people like discount, they like free.
Yeah.
But when it comes to how much they value a course, they value it based on price.
Okay.
And it's purely psychological. So if there's two artists performing in Kenya, and the tickets are going for 500 for the first artist.
Yeah.
And the other one is going for 5K for the second artist. People will tend to give perceived value of the expensive performance as more valuable compared to the cheaper one, even if, let's say, the guy charging 500 is the bigger star with more quality performance. So there's that thing that people want to extract every value once they have paid. But if they have not paid for it, they don't want to extract the full value of that content. Yeah.
Okay. Interesting. Hopefully, personally, I think I landed for free. I never paid a single course.
Yeah.
And I think I can't complain so far.
So the thing is, if you're backtesting and it's just on MMT4 and MMT5, most people will approach it as if it's for fun. They might even share on social media and say, I have this strategy. If I used it for the last, 2 years on, let's say, the NASDAQ, I could have made this amount. But the moment you have that paid subscription, and I'm not promoting and I'm not telling anyone to make a subscription, I'm just saying that there's that mental framework where when you pay for something, you tend to extract every possible value from that platform.
I usually think and approach the markets like this. If I'm backtesting on the MT5, for example, or MT4, the profits are non-essential to me.
Yeah.
I'm looking at the success rate.
Yeah.
How the skill I used to enter, or the precision I used to enter the markets.
Yeah.
Look at the results, statistics. They will tell you you have a win ratio of this, you have a profitability ratio of this, you have a drawdown percentage of this. So if I see a drawdown exceeding 20%, what cost it? Let's say on MT4 or 5, you can even pull your Excel sheet and have a whole analysis, and you're able to do that. So as much as my strategy, if I'm going to a new one, I will use that to gauge if it is worth it to transition it to live. If I'm studying maybe a certain commodity or asset class, and I want to incorporate it into my, a pool of assets that whenever, like yesterday when nothing was happening, I think euro dollar was doing something and it was a Juneteenth. So that I have something that if I need to make maybe a few pips, I will do it. But I focus on the skill. Even if I make $1 million on the demo, it means nothing to me. I will just balance on the demo account compared to what I want or wish to achieve on the live. Start from there and focus on how successful is this skill, and hopefully transfer the skill now to the live. I don't know if that makes sense.
It makes a lot of sense.
Okay.
Funny enough, I haven't changed my trading strategy in the last 6-7 years.
Yeah.
Of course, I make some small changes. Like if you've noticed over the last 2-3 years, I've mainly focused on less trades in the forex market and more trades on the equities market. So you realize I'm doing more trades on indices compared to currencies. And that's an adjustment based on the feedback I'm getting. Like if I apply a lot of trades on, let's say, Euro USD, compared to the UK 100, I'm getting more returns from UK 100. So I shifted a little bit towards the indices side.
The strategy was working. It was giving you predictable results. Now you need predictable big results.
It's just fine tuning. You keep improving.
I get you. Maybe as we wrap it up, what would be, an advice to somebody who has done all possible strategies you can ever think about in this beautiful created earth?
Well,
where would they start?
My advice is keep it simple. The simpler it gets, the better. Second thing, once you've made it simple, focus on different asset classes. Try to understand how your strategy is performing on, let's say, the majors, compared to indices, compared to commodities, compared to ETFs. Even if you can get crypto, just try it out. You can even do it on a demo. See what asset class is responding best to your strategy, and don't stop that process. Keep just reevaluating, because market conditions change over time. So for instance, I would say 2020, 2021, it was almost a straight line on Euro USD. The euro was just losing to the dollar until we got to below parity, right? If you look at the price action last year, it was just up and down, up and down. We didn't have a straightforward direction. So there are market conditions that might determine how your strategy is performing. So if market conditions are straightforward, you have a directional bias, the market is moving up or down, then that might be good for your strategy. For markets that are moving sideways, might be different results for your strategy. So it's all about constantly looking at the markets that favor your strategy.
Interesting. For me, very simple. Consistency and discipline.
Yeah.
I think that is the only thing that can assist you, such that even if your equity falls to a certain level that you don't find it conducive to your strategy, you can just pause for a minute, relax, maybe see what you can do if you must, so that you don't necessarily just wake up, let me just do this, let me just do this. Stick to it and diversify. So consistency of the same thing over and over, so that you know, you like every trade, you know the worst that can happen, the best that can happen, and you avoid one thing. I think for me, I normally say, avoid blowing your account within the 6 months you are trading. If you have a good account of, let's say, $200, there is no reason whatsoever for you to blow that money within a month. You can do it even 3 months, making 10%. If at all you are not trying to flip it, of course. But if you're just trying to make some small cash from it, keep it like that. If you're trying to flip, I really don't have any advice for that. I think that you will need to backtest your flipping strategy until you find some degree of confidence that it is giving you what you wish to achieve.
Interesting. I have a carrot and a stick.
Okay.
I know you've been very, very consistent this year.
Yeah.
So are you looking to change your FPL strategy on the next season?
No. No.
So here's the thing. Would you say that it was your strategy that was bad last season, or the market conditions were bad?
No, my opponents are good. My opponents are good. I mean, I have you and I have a couple of guys. We're averaging 70 to 80 per week. So I don't think my strategy was bad. I think my opponent were just good and lucky to have one thing or the other. But again, if we relate that to money, we are not competing of how much do you make per trade, but am I content with what I make from it? And when we compare the notes, there is that positive consistency of returns. I think that is the most important thing. So even if my FPL maybe out of a group we have, you come in number 3, I don't think that's a bad position.
It's not a bad position. If let's say those teams are trading accounts, and somebody got a much bigger return, but you still got a return, it's a win-win for everyone.
And most importantly, of the 38 matches, you came in at least 3 times equal number of your top 3 who had 1 or 2 extra matches which topped you out. So it means my strategy was right. I'm just pointing out that.
Market conditions were not favorable.
The opponent were playing rough. I think that marks a very interesting topic on strategy. Perhaps should you be having some input on that? Of course, we are not the gods of this business. We just view and share our opinion, and we believe it might add something, it might not add something, but your feedback can be very much appreciated. I've been your host, Jesse. Of course, remember to like, share, subscribe, comment on all the DSPs that you are in, and of course, interact with us on our social media handles, which will be also shared down below. Remember to, of course, your feedback is our energy. So on Spotify, share your review, share your comment, question. Same thing, that will be Bullish Banter. Of course, like it, share. YouTube as well, share your comment, add in your opinion. And if you can't find us on either YouTube or Spotify, you can find us on X, ask your question. We'll be glad to have you.